In the modern corporate world, investors are obsessed with the top line. The standard definition of success is relentless revenue growth, an endless upward climb where a company has to sell more year after year just to keep Wall Street happy. But look at a company like Singapore-based Nordic Group and their Q1 2026 financial update. This chart illustrates their revenue trajectory for the quarter. Instead of a steep upward curve, we see a remarkably flat, stagnant line. They pulled in 41.8 million Singapore dollars, which is a tiny 0.5% increase compared to the previous year. Under standard corporate logic, flat revenue means a business is stalling out. It usually signals that market demand has dried up, triggering immediate panic and sell-offs from shareholders. Yet Nordic's underlying numbers tell a completely different story. While their revenue barely moved, their net profit jumped by 11% to $5 million. Their net profit margins also expanded by 1.2 percentage points, reaching 12%. Look at this bar chart comparing their key metrics. The revenue bar on the left is practically frozen, but the net cash position is shooting up by 149%, bringing their total cash on hand to $10.2 million. The people running the company are acting on this underlying strength. Management currently holds roughly 75% of all available shares. Over the past few years, these insiders have bought back over 2 million of their own shares at a steep discount. They acquired them at an average of 38 cents per share, well below the recent trading price of 58 cents. A business generating massive cash with expanding profit margins and heavy insider buying, all without expanding sales volume, requires a closer look at how it actually makes its money. Over the years, Nordic abandoned low-margin, generic contracting. They pivoted to highly specialized, complex environments, like engineering cleanrooms for semiconductor plants, designing automation systems for marine vessels, and building ballistic systems for defense. This specialization feeds into the first half of their operational strategy, engineering solutions. This is their project delivery engine, focusing on turnkey, end-to-end design and construction. This schematic maps how project delivery creates future business. The left shows the engineering solutions process, from design through testing, feeding directly into lifecycle maintenance. That loop activates their second engine, engineering services. They transition into the long-term maintenance provider for that exact same site. By building the initial infrastructure, they essentially hire themselves for the ongoing upkeep. A single one-off capital expenditure from a client becomes a permanent, reliable operational revenue stream for Nordic. We can measure the financial impact of this dual-engine setup by looking at their future backlog. This is a breakdown of their total $213.5 million order book. As highlighted in this area chart, a massive $146.9 million of that total is dedicated entirely to recurring maintenance contracts. This execution-led support creates a massive financial buffer. It generates steady cash flow month after month, completely regardless of what the broader macroeconomic economy is doing. Because the bulk of their future cash is already locked in through these maintenance agreements, they are shielded from macroeconomic shocks. They don't have to scramble to win risky, low-margin mega projects just to keep their operations running. That steady, guaranteed cash flow from their maintenance contracts puts the company in a position of high financial leverage. Since they aren't desperate for operating capital, they can hold on to those deeply discounted treasury shares we mentioned earlier. Instead of selling equity to survive, management can strategically deploy those shares later to fund mid-sized corporate acquisitions. They are also actively applying their engineering capabilities to new, high-demand sectors, with their upcoming Avi Tools Thailand facility serving as the next major growth catalyst. They are using their precision engineering skills to mass-produce structural components for industrial battery storage. It is a classic picks and shovels approach to the booming green energy market, supplying the essential hardware required by the industry's major players. As this facility transitions from small batch testing to full mass production, analysts project it will reach an annual revenue run rate of $20 million. Corporate resilience and long-term financial growth do not always require explosive, viral sales figures. By engineering deep, recurring revenue moats and maintaining strict capital discipline, a company can steadily compound its wealth, even when the top-line numbers appear entirely flat.